Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Steve Sosnick, chief strategist at Interactive Brokers. We're here to discuss what's happening below the surface, even with some caution flags around the tried and true strategies like buy the dip. Steve, it's still in play. If you take a look at the market where we are year to date and weren't aware of what's happening over the past 6 months, you'd be surprised that it was as volatile as it is in between, considering we're nearly flat on the year.
Yeah, that's a great point, Jill. It's great to see you as always, by the way. But I was just running the numbers and through Friday, the S&P 500 was up about 2% year to date. When I break it down into growth versus value categories, the value category was essentially flat. It was like down like 0.006 or something of that nature percent. And the growth category was up, call it a little under 4%. NDX broadly moves with the growth index, so NDX has outperformed SPX. But yeah, if you somehow had like been on a desert island for the last 6 months and looked up, you'd say, okay, my portfolio's chugging along here, not a lot of volatility. And that's hard. We know that's not been the case.
What do you think are some of the caution flags below the surface that perhaps the equity market is brushing off or doesn't feel as if, we need to take as much caution here?
Well, I mean, we're so driven by momentum, and one of the themes that I've been stressing is if you're purely trading on momentum, and you can do this. This is not like me being, saying, oh, we've got to go look only at value stocks. You've only got to look at fundamentals. But if you're strictly trading off of momentum, meaning that you are just looking at price action and trends, you are saying, I'm going to overlook the fundamentals. I can afford in the short term not to care about the fundamentals. So that number one is a risk in and of itself. Number two is I do want to express a little concern about the bond market here, and I know we're stock people and we talk stock and options primarily, but ultimately the bond market is going to hold the key here because one of the things we've been a bit concerned about is money flowing out of the U.S. in general. We're not seeing it flow out of U.S. stocks right now, but we've seen a number of days where rates have moved higher, but the dollar has moved lower. Typically, when you have the dollar moving a bit lower, I'm sorry, when you have rates moving lower, the dollar moves lower. When you have rates moving higher, the dollar moves higher because of the interest rate differential. And that differential has grown vis-a-vis the ECB because they're cutting rates and we're not. But yet we see the euro continue to strengthen. And that's one of the things I'm watching for. Um, Below the surface also, we see another one that I think gives me a little pause is the last time we were up here around 6,000 on S&P 500. The expectation for S&P earnings growth was around 12 or 13%. Now that's closer to 7%. So we're paying the same prices for things, but yet expecting half the growth. Not exactly, but call it 40% less growth. That's something to be a little bit cautious about. But again, if momentum is in command, that stuff can be overlooked in the short to intermediate term.
Yeah. I mean, you're talking about momentum, and we've seen this throughout the course of the year. It seems to be the larger cap mega growth names, right? That are, taking the market down or up. So it seems as if you need to think about a more natural hedge as it relates to those basket of stocks.
Yeah, I mean, this is something I intend to publish tomorrow, so you're getting a first look at it. Actually, I ran some numbers. I mentioned earlier S&P value versus S&P growth versus the S&P itself. So the S&P itself is up about, call it 20%. I'm going to use some round numbers here. The S&P value portion, SVX, is up about 13%. The S&P growth, I'm sorry, this is since April. I apologize. I used the numbers earlier year to date, 0, 2, and 4. And since the lows on April 8th, we've seen the S&P value index up about 13%, the S&P itself up about 20%, and the S&P growth index up about 27%. So twofold performance for the growth index. But again, one of the things I've noticed is NDX and SGX move almost in lockstep. And that's because they're dominated by the same group of stocks, the mega cap tech stocks. So regardless of whether you are over invested in those stocks or just highly invested in them because you own again, even if you own the S&P 500 through, through an index fund or something, you're still heavily invested in mega cap tech. But I think what you'd want to do here is the message is telling us that because the outperformance has been so great since April, it also means the underperformance was dramatic as the market was falling. So one of my themes has been don't fight the tape, but insure against it. And I think the place to insure against it is actually using NDX or related products, because if there is a fall, it's going to be disproportionately weighted toward those same stocks that have been winners, because we saw it before. This is not just me being Pollyanna-ish. The data is actually quite stark. They overperform on the way up and they underperform on the way down. And so if you're trying to hedge, you want to hedge where your underperformance is going to be greatest. So I think it's actually quite reasonable to say I may have a more diversified, not as tech heavy portfolio right now or I may just want to have that portfolio because I want the momentum. But if I'm going to hedge, I'm going to want my hedges to be a bit more linked to NDX than I will SPX.
All right, Steve, appreciate the insight. As always, thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.